Hello and welcome to MasterChartsTrading.com market recap for the week ending Friday, January 23rd, 2015. This Friday, a buy signal was generated by our trading system on the S&P 500. However, the choppiness in the market still remains, and possibly because we're right in the middle of the earnings season. I may sound like a broken record, but this week bonds hit all-time high yet again. Gold is already under pressure, and this is despite a new 11-year low in euro and the ECB quantitative easing intervention. We'll also look at a bearish engulfing pattern that unfolded in GDX, the ETF for gold miners, and we'll look at a possible retracement target. Also, oil is currently at support, but USO, the ETF linked to oil, hit another 52-week low, and this could be a precursor for a lower prices in oil. And finally, we'll look at the defensive sectors, and they are indeed attracting money right now. All right, so, All right, let's look at S&P 500. So I've shown this chart in the past. And S&P 500 is in a long-term uptrend. Within this uptrend, there were quite a few buying opportunities. And in fact, the latest one was just yesterday. The latest one was on 22nd of January, right there. And we entered the market somewhere during the middle of the day. So, as of right now, basically the chart, I'll show it better on the next chart because it's kind of not very clear on this chart, but let me show you on the next chart. So you can see, let me just move this over a little bit like that. You can see right here we had a big candlestick on the 22nd, and then today we had what's called an inside day. In other words, this entire range for today was within the yesterday's candlestick. So, this is a kind of like an important pattern, and whichever way this range resolves, so if it breaks out, then definitely it'll be a strong, powerful signal to the upside. And if it breaks down, then of course it will be negated. But if we look at the market breadth, we can see that, let me just move this over a little bit, like that maybe. If you look at the market breadth for S&P 500, so the market breadth is actually quite bullish, and the percentage of stocks above the 50-day moving average, the percentage of stock above the 200-day exponential moving average, bullish percent index slightly lagging, but it's still above 50%, so it's definitely in the bullish territory. And the New York Times, New York Stock Exchange new highs, new lows indicator actually surged to new highs for January. You can see it's pretty high. So, and then also the S&P 500 advanced decline line, I don't see a divergence yet in it. So it looks like, it's kind of moving lower, and the price as well is moving lower. So no divergence in S&P in the advanced decline line, which is a good thing. And then also we had a bullish engulfing pattern right there, and it resolved to the upside. So far it's looking good and looking bullish, and I would actually think that we may see new highs pretty soon. So let me show you another chart that may further the case for this as well, and that's of the New York Stock Exchange Composite Index. And on this chart, let me just get rid of this overhead. Okay, so you can see that I've shown the chart in the past as well, but you can see that the S&P, the New York Stock Exchange Composite Index has been making kind of like a lower highs, while the New York Stock Exchange Advanced Decline line has been making higher highs. So this is called a bullish divergence, when the price is moving lower but the advanced decline line is moving higher. And the same for advanced decline volume line, which represents the kind of like a large cap stocks, has been also moving higher. So both advanced decline line and advanced decline volume lines been moving higher, while the price has been trending kind of the highs were making lower highs. So to me, this looks like a bullish divergence, and I think it might resolve to the upside. So we may actually see new highs in New York Exchange Composite Index, hopefully soon. Okay, so let's look at the bonds. This is TLT, Treasury 20+ year Treasury Bond Fund. Shown this chart in the past as well. This is a bullish chart, and it's pretty clearly bullish. I don't think you can argue with this uptrend. We had several buying opportunities within the uptrend, latest one of which was on January 2nd, and from the entry point we're up about, let me see, 6.5% or so. So TLT is certainly showing signs of being overbought, and we may already have started seeing some selling pressure. Like, for example, see this price momentum oscillator, kind of already rolled over to the downside. So I would not be surprised if we see a retrace to maybe 127 area right here, possibly lower. I don't know, but important thing is that there is a strong bid into the bond market, and this is definitely weighing on the stock market, especially on the small caps, especially on the small cap banks. So let's look at gold. But before we look at gold, let me just show you the chart of euro. And this is price of euro. This is a monthly chart. I actually had to zoom out quite a bit out to show you what I'm trying to say. So as you may know, just this week, European Central Bank has announced that they will expand and continue their bond buying program, which is quantitative easing in Europe as well. And of course that had a very negative effect on the euro and the currency, the common currency. In fact, it sank to an 11-year low. So going back, this is price of euro has not been this low since 2003. And if you're traveling to Europe, this is great news, because you can, buy. It'll be just cheaper for you to travel there, and it's great news for European companies as well, because it's making their export cheaper. But some may argue that this is not good because it's debasing currency. I don't know, but in any case, the gold usually is a good indicator of when the money starts being printed, gold usually gains. So let's look at gold, and indeed gold has gained from our January 6th entry point right there. It's up about 6% or so. Let me just see, 120, maybe a little. Let me see, 120, close to 124. So we entered about here, almost 7%. So we're gaining about 7% in this swing trade, possibly a position trade. But today already gold lost 0.8%. This is GLD, 0.8% already today, and there seems to be some signs that it may roll over back, and at the very least retrace some of this advance. And I mean, even in the face of 11 year low in euro, gold is not that powerfully going up. So it's a little bit cause for concern. I mean, we still have a position open, but we did take some profits already in this gold swing. And I think the next chart, actually GDX, same thing. You know, we entered on January 6th right here, but GDX of course is much more volatile, and for the same period, let me see, look close 2174, so the same period it gained about 16%. However, let me show you the next chart. So let me just do this. There are several things. It's a little bit busy chart, but let me just go through it one at a time. First of all, a breakout occurred, and right here on January, I believe, 6th or 7th, and the breakout happened when GDX closed above the 50-day moving average, confirmed the next day. We were able to enter the market around here, but you can see this pattern right here. So a white is kind of more obvious here. A white candlestick, completely engulfed, completely covered by a big red candlestick. So this is called a bearish engulfing pattern. And by itself, bearish engulfing, doesn't necessarily have to be bearish. But the next day and the next day after that, it confirmed by lower prices, and especially this gap down as well. So this particular bearish engulfing happened in I think a pretty bad place for GDX, because this green line right here is a 200-day moving average. First, it closed above it, but the next day it just couldn't hold it, and the next day it didn't hold it as well. So one of the methods of trading is to have a confirmation. So it closed one day above it, but the second day it didn't confirm, and this bearish engulfing is at the top of a range. So you can see it started here and went up and up and up and up and up, closed at the top of the range, but did not hold. So this bearish engulfing to me looks kind of ominous, and we could easily see a retrace to this 50 to 38%, 30 to 50% Fibonacci retracement area. Even possibly lower, because as I said before, GDX is still long-term bearish, as is gold and as is silver as well. So if this rolls over and there is significant selling pressure, we could potentially see new lows. Who knows? But if we look at the, let me just move this chart up. So these are market breadth indicators for the gold miners, and they are looking much better, honestly. So this is a advanced decline percent line and advanced decline volume percent line, and they are kind of trending up together with the actual security. So that's good news. And bullish percent index is at 50%. So it's kind of like a moment of truth for this. This 50% is sort of like a borderline bullish, or is it borderline bearish? So and actually see today, you can see the new highs, new lows indicator turned negative again, and this is not a good sign. It was barely positive for a little while here, now it rolled over. See how it was negative here, and the prices were just collapsing? So I'm expecting at the very least a retrace somewhere around this area, or if it's there is enough selling pressure, then we may see new lows. So we did take profits in GDX, we did take profits in GLD, but we still have a position, some of the position open in both of these. All right, let's look at oil. So West Texas Intermediate crude oil. Let me just disable this rollover. So I highlighted this potential bear flag, or decline, pennant, breakdown right there, and then another decline. Now it looks like we're having some sort of flat consolidation in the 40s area. But today, again, oil lost some 2.6%, and it now entered this area of potential support. Like, for example, right here is a hammer candlestick, and there was some support around this area. But if oil if oil closes below this 44.20, then we could easily see prices in the high 30s for oil. For now, price momentum oscillator is still on the buy signal. It's possible it will hold support. However, let me show you the next chart of United States Oil Fund, USO, which is a tradable vehicle for for oil if you're trading this. So same things. You can see breakdown, consolidation, another breakdown, another consolidation, breakdown with a gap down, huge gap, huge move down, another consolidation, another breakdown, and today on Friday another breakdown. See how it made a new 52 look low and closed below this low right there. So it's possible we may see even lower prices in oil, and yeah, who knows. All right, and then wanted to highlight some of the defensive sectors as they were attracting quite a bit of money lately. So XLU, Utility Select Sector SPDR, this is kind of like a large cap utilities stocks in it, and you can see there's some listing of the utilities that are in it. And our signal to buy was on October 7th of last year. That's a while ago, and position is still open. There was really no sell signal. You can see the Arun green is still above the red, and no sell signal. So this position, let me see, it gained like 16% or so. Still open. So this kind of shows that money is rotating out of the risk into a risk-off areas, and the XLU utilities are traditionally one of the risk-off areas. And then another sector that's attracting money is real estate, and undoubtedly due to very low interest rates and bonds, being at all-time highs. Also, same thing. The buy was on October 14 for us per our trading system, and it gained, let me see, even higher, like 16, 17%, 17.5%, and still no slowdown. You see the green Arun is still above the red Arun, so you still see money coming into the real estate sector, and these are all kind of defensive sectors. And I wanted to highlight one last chart, and that's of Procter & Gamble, which is a consumer staple, which is a defensive stock. And very similar chart. For us, the buy signal was on October 24th, and it was up as much as 11. Let me see. It was up as much as, I think, 11%. This stock just doesn't move as much. It's kind of like a steady long-term stock, but it did sell off a little bit, but it's still on a buy signal. There was still no red Arun surging to 100 just yet, so position is still open. Would have still been open. So this just highlights how money is rotating out of kind of riskier stocks and moving into more defensive areas. But having said that, stock market can easily push higher because even the defensive sectors like healthcare, utilities, real estate, and consumer staples, they still make up, a significant percentage of the S&P 500. So we could still see even higher prices in the S&P 500, especially if bond market kind of slows down just a little bit and maybe retraces some of its steps. So finally, I wanted to show you how to find us on the internet. So to find us on the internet, go to MasterChartsTrading.com, MasterChartsTrading.com, and of course, my comments are posted on the blog, and I also added a new section called videos. So all the videos, most of the videos that are there, you can see them here and watch them here as well. And so make sure to sign up for our mailing list right there. And also, most of these charts, or all of these charts, are located right here. If you click on this link, public chart list, and you can follow along on those charts. We will have soon a members only section where I will post some other charts that are not listed on the public charts page. For now, our subscription list is free, but we may start a trading service sometime in the future. And also, if you have a Twitter account, a Facebook, a YouTube account, or a StockTwits account, you can follow us there on those pages as well. And there are links there on MasterChartsTrading.com. All right, that's it for this week's recap. Thank you for listening, and have another great trading week. Goodbye.